Welcome back, and in this video we are going to break down how do you choose a financial advisor. What are the things that you need to look for? What are the things you need to be careful of? And it's quite a big list, so I'm going to aim to get through it as quick as possible. However, these are really important, and whenever you are seeking independent advice, it's really important that you take these into account. Why? Well, choosing a financial advisor is a critical decision. It can significantly impact your wealth, lifestyle, and ultimately your future. So here's a clear and structured guide to help you choose wisely. Number one, first and foremost, you must define your needs. Start by identifying why you need an advisor, whether it's retirement planning, investing, stocks, property, funds, alternatives, whatever that may be. Tax optimization, wealth preservation for future generations, or for any reason that you may choose. Estate planning, and also if you're an expat, then it's very different. It will be expat financial planning advice, which is a whole different area in and itself. Once you've ascertained what it is you're looking, your why, then that will help match you with an advisor that can help with your specific goals. And that brings me on to point number two, which is know the types of different advisors. So you've got fee-only advisors that are paid directly by you. No commissions equals fewer conflicts of interest. Then you've got commission-based advisors. Now, the minute you say commission-based, people are like, oh, but that's not entirely accurate. What a commission-based advisor means is they are paid by product providers. And to be fair, they may have a bias towards those particular product providers, but we'll get into that in more detail throughout this video. So it's important to work out, the different types. Then you've got fee-based advisors. And what is a fee-based advisor? Well, it's a combination of both, and you need to understand where the incentive lies for the advisor. And then you've got independent versus tied. Now, an independent advisor has access to more products and solutions. They take a whole of market approach, is the terminology within the industry. Whereas a tied advisor, well, you can kind of get it. They're tied to a particular institution or product provider. That may be insurance, or it could be investments, but whatever, that's what you need to find out. Number three would be check their qualifications. Look for credible certifications. If that is a CFP or a chartered financial analyst, make sure they're regulated by the proper bodies. I live in Singapore, so in Singapore it's under MAS. In the UK it's the FCA. And in the US, it's the SEC. So that's really important. Number four is understand the advisor's investment philosophy. This is really important. And how do you do that? Well, you want to understand if they are believers in active or passive investing. Active is where you're actively trading the market. Something I only recommend doing if you have an in-depth knowledge of markets, and, in turn, the advisor has that too. Whereas passive investing, it's more just kind of buying, holding for the long term, and riding the ups and downs that will inevitably come when you are investing in markets and effectively speculating. Speculating meaning you're speculating on the price of a particular stock or a fund or whatever that may be going up in the future. Also, you want to understand how do they customize portfolios, because when you sit with any advisor, you want to be doing a risk assessment, you want to be talking about timelines, you want to be talking about goals, and You want to make sure that the person you're speaking to or the company you're speaking to can align with that and also align with your values and your temperament. So if you are someone that gets very nervous about investing in money or it keeps you up at night, then you probably don't want to be looking at things like hedge funds or commodities. I'm just going off the cuff here. So that's really important too. Number 6 is number 5, I beg your pardon on my list here in my mind. So it's number 5 is ask how they are paid. That transparency is always key in any relationship, yeah? So ask, do they charge a flat fee or a percentage of assets? Do they receive commissions? If so, from which products and which providers? And also ask, are there any hidden fees or trailing commissions? Now, what trailing commissions means is that if there are particular funds that may be paying, the advisor may be incentivized to use because they're getting a trailing commission from it. Okay. Number 6, assess their fiduciary duty. A fiduciary is legally bound to act in your best interest. Not all advisors are, so ask directly. Are you a fiduciary at all times when you're giving me advice? And they should be able to give you a fast and a direct answer. It means basically doing things that are within your best interest. Now, that is anyone with any integrity, you would just expect that, but there you go. It's definitely one for the list. Then number 8, I think this is really important. Ask for references or reviews. If they don't have any reviews online, ask for, to be introduced to a client. There's absolutely nothing wrong with that. And anyone that is good at what they do should have no issue in accommodating you. So yeah, or check testimonials, look on LinkedIn. That would give you an idea of people they've worked with, the types of clients they have, and what kind of job they have done. And that brings us to number 9. Review their tools and their access. So, what does that mean? It sounds pretty broad. I would say, okay, I'm thinking off the most important is, do they have access to global investments, trusts, or offshore companies? Do they work with tax and legal experts? And do they provide you with a digital dashboard and regular reporting and also reviews with the advisor? You don't want to go and choose someone and then you start investing and you never hear from them again. Personally, I think a good benchmark is quarterly reviews each quarter, or at the absolute minimum, half-yearly reviews. And then that brings us to number 10, which is start with a discovery meeting. Any good advisor should offer a no-fee, no-obligation consultation. And what that does is it allows them to understand your goals before making any kind of proposal. If you have come across someone that just gives you a recommendation off the cuff, which is pretty unlikely in my opinion, that's not really, I've not come across that, but hey, you never know, right? But yeah, make sure you have an in-depth analysis of your situation. Again, that goes into what your objectives are, your timelines, your risk profiles, your kind of psychological approach towards investing, and so forth. And I guess I'll finish off with some questions to summarize what we've just been through, because it's quite a long video. I'm going to wrap it up. Questions I would recommend would be, how are they compensated? What services do they provide? Are they independent or tied to a specific provider? What's their investment philosophy? who is their typical client and would they be okay if you were to speak with that client, and what happens if you want to leave. That's a good one. That's really important. You want to make sure you understand, are you free to leave if you want to? Are you free to move your account to another advisory firm if you're not happy? And that's my list. So there we go. Thank you for watching. Thank you for listening. And if you find this useful and you want more information, drop us an email at info@expatmoneychat. Hit the follow, hit the subscribe. Much appreciated. Thank you.